Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, with the one and only John Mousseau, the Moose. Well, in our chat today, it's going to be very short on my end, so I'm going to leave John some time. This week, and really the last couple weeks into 3 weeks, growth has just gotten back into drive. As a matter of fact, if you broke down all different types of sectors, industries, styles, value, versus growth, small cap, mid cap, large cap. By far, the last 10 trading days, large cap growth has been back in style. Right. When you look at where we want to be positioned, we started to see over the last quarter, over the last 3 months, some diversification start to work. Small caps, mid cap, and listen, when I say large cap growth, the last 5 or 10 days. That's a very short period we're looking at. But if that continues, it kind of reminds us of what we saw earlier this year, where if you weren't in large cap growth, you really struggled. So it would be interesting next week and into the end of the year, into January, to see if that continues. Have a good amount of speculation going on in the equity markets right now.
Yeah.
We see that by what's working. You see some really ne'er-do-wells or poor balance sheet companies getting real nice spikes.
Right.
So we have a little speculative run here. We'll see if that continues.
Yeah, I mean, in bonds, today we had the jobs number for November. Came in a little higher than expected. They were expecting 220,000, came in at 227,000, so not a big jump. A big change from last month, because what you have now is you have the noise of the hurricanes out of the numbers. You have the strikes like at Boeing out of the numbers. So you're getting back to normalcy. Yeah. Getting back to normalcy means a little more normalcy in the bond market. So 10-year Treasury was like at a 4.17 after today. It's a 4.15. By the way, the unemployment rate ticked up to 4.2 from 4.1. On the muni side, AAA 10 years at a 2.73. That was down 4 or 5 ticks this week. Here's the important part. That 273 was 3% on a 10-year bond right after the election. That 415 10-year Treasury bond was about a 445 right after the election. So down about 25 and 30 basis points respectively since the election and all the froth that went on. What does that mean? It means it's a reversion of the mean. The markets are getting a little more comfortable. We now have Scott Bessent coming in as the nominee for the Treasury Secretary. That should fly in. Obviously, there's some other nominations for the cabinet that are, have to be walked around a little bit. But the important things like the state and Treasury, the markets are taking comfort with that. And I think that's a pretty good sign for the bond markets. Next week we have the CPI and the PPI numbers. They'll probably come in around 0.3. That'll actually boost up the year-over-year numbers a touch. But I think the idea is today's numbers probably gives the Fed a little room to maybe cut next month, or this month rather, to 25 basis points. And if they're gonna take a break on cutting rates, they'll do it in the new year.
Yeah. Great info. So to wrap up, equity, technology, consumer discretionary, communications. Those are where the bid is in the market right now. The defensive sector is very quiet. We'll see if that rotation is short-term and we can get more diversification, more demand spreading out. The breadth, what we talked about for a quarter or so, was very solid. Let's see if we can get that breadth to expand again, or is it going to stay narrow in that large cap growth? We'll watch, we'll react, we'll position. Enjoy the weekend. See you next Friday.